Welcome to a video that I like to call the deep dive video. Please don't let this name mislead you. I use this in a little bit different context. Every week I do a number of videos. I do a video every day, and then I do an intermarket analysis video. And in both of those videos, I use daily charts in order to do my analysis. I also do a weekly video. Then at the end of each week, the last video that I do is I go through all of the daily charts and I pick out those charts that maybe I didn't talk about either at all or maybe just mentioned briefly, because sometimes we can still get some insight from these charts, even though they're not really screaming at us really loudly right now. We can get some confirmation as to the direction or the condition of the trend or of the state of the S&P 500. This is being prepared for Monday, September 11th, kind of an ominous day where we celebrate a very sad history. The first chart that we look at is the chart of the VIX. Now, you don't see the VIX on here. It's here, but it's invisible. On top of that, I plot a 50-period exponential moving average. Typically with the VIX, we use static numbers, where we might go from 12 to 12.5 to the downside. That's when the market is considered to be very complacent. And then we go with 20 to the upside, where the market is said to be full of fear. Well, you can see just by looking at the moving average here that we don't always stay within those boundaries, because the VIX itself can be dynamic over time. Sometimes we get to a really high range like we had after the big financial crisis back in 2008 into 2009. Then from about 2012 or 13 or so up until the COVID plunge, the range for the VIX really dropped to a lower level. Then after the COVID plunge, we went back up, and currently over on the right-hand side, we're starting to see things really drop. We won't know for quite some time now if we are going to actually change into a lower trend as far as the VIX is concerned. We can just look at this over time and then figure out where we are based on history, as well as applying that right now. Another thing that we look at is the VIX on a daily basis, and then compare it to a 3-month average of the VIX, and then take a ratio between the two. What we're seeing down here is mainly the red line. I plot a 50-period moving average on here, and it's continuing to go up, showing that fear is starting to increase slightly. Then sometimes we can't really make heads or tails of the VIX itself, so we do some additional studies. We look at the VIX to S&P 500 correlation. And sometimes when this really spikes up and then starts to come down, that might be telling us something when maybe the VIX is not doing that. Well, right now we're getting a very low reading for this overall correlation. So this chart really isn't telling us anything currently. Then we also look at something similar to the VIX called the skew index. The VIX looks at whatever the current at the money options are. The skew index looks at out of the money options, both above and below, and tries to come up with this concept of, okay, is the market going to move? We don't necessarily know in what direction, but when we see this really getting up into the red area, the market is expecting some kind of a big move. If you go back and look at other times when we spiked up and then started to come down, sometimes that meant a continuation of what was already happening. Sometimes that marked the bottom, sometimes that marked the top. Right now, we're just about in the middle, so we're not really getting much from this chart. We also look at the VIX and then plot an RSI 9 period on here just to see if we're moving up or down really fast. We did almost get to an extreme negative reading as the VIX was going down. That's when stocks were going up. But right now, even though we're below 50, we're not really getting an extreme reading. Another VIX study is we look at a thing called the MOVE index, where the VIX measures the volatility of stocks. The MOVE index looks at the volatility of bonds. Down here in this red-green area, the red is the S&P 500 and the green is the spread between the VIX and the MOVE index, just to see how they're moving. What I pay attention to on the bottom is the correlation between the two. And we had been a little bit stronger, meaning they're going in the same direction, but that's starting to trail off just slightly. Then we look at a ratio between the VIX and MOVE index. When this is really going up, that means there's more fear. When it's going down, that means there's less fear. We've been chopping around quite a bit. We were starting to go up slightly if we look at the moving average while we were having some difficulties in August, but now we are starting to flatten out and the moving average is actually turning down, showing that things are calming down for the time being. But that could change at any time. We also have a daily chart of the equity put call ratio. This also helps us to look at sentiment, fear, and greed. Well, this is a daily chart, and most of the time when I get ready to record the daily video, this chart hasn't updated yet, even though that's many hours after the market has closed. We were declining a little bit here on the daily chart. And then when we're going up, that typically means that the market is going down. And when we're going down, that usually means the market is going up. So this is pretty spastic overall. It really moves around quickly. So we look at other studies taking moving averages over different periods of time to try to get an idea of the overall trend. Then here's a fear gauge that we typically look at. And there's other fear gauges beyond the VIX. This one just shows that when it's going up, that means that fear is increasing. When it's going down, fear is decreasing. It's kind of hard to tell because we've been really chopping sideways with this chart lately. And for pretty much all of 2022, even going back into early 2023, but we are ticking up just a little bit as we're getting a little more fear into the market. Then we also look at the NYSE. That's a broader measure of the market. We look at the common stock based on price of the advanced decline line and then based on volume. And we're not really seeing all that much right now. We were starting to show some real improvement. We've come back down. We haven't really broken down with this yet, but we haven't really broken out either. And we're seeing pretty much that same thing based on volume. And we're looking at volume. And since we're dealing with the summer months, even though it's picking back up a little bit, the black line's going up and it's above the red line. As long as we're below this midpoint, we're still below average. Excuse me. Then we keep an eye on where are we when compared to the all-time high. We're down 7.49%. And then over on the right-hand side, we have where we closed after Friday's session. Excuse me. Then another thing that stockcharts.com makes available are technical alerts. And I did it a little different this time. This is for the entire week because we had a shortened week, only 4 days instead of 5. We start at the bottom and then read our way up to the top. Where back on Tuesday, we had a couple of signals that were triggered. When they're red, that's negative. When they're green or blue, depending on how you see this, they are positive. And we look at not only the S&P, but different sectors that make up the S&P. We look at the Dow, we look at the NASDAQ 100, and we can get some information about what's happening across the market as a whole. Then we look at index technical scores. Now, everything I do is focused around the S&P 500, but that means that we don't just look at the S&P 500. We look at other indexes. We look at the Dow, of course, the S&P. We look at the NASDAQ 100. We also look at the mid caps and the small caps. And stockcharts.com has this tool available to rate the technical scores. The better looking the chart, the higher the score on a scale from 0 to 100. First place is the QQQs, or are the QQQs, at 97.1. Now, this hasn't been all that helpful to us because if you look at how this has changed over the last few months, this has pretty much been flatlining. Earlier on, the Qs, meaning the NASDAQ 100, have been going up so strong that now that we're pulling back and having some difficulties, it's not really registering as far as this tool is concerned for measuring the technical score, but it's still giving us a high score anyway. Then in second place is the S&P 500. There are lots of stocks in the S&P 500 that come also from the NASDAQ 100, and this has been flatlining as well. It's looking not as strong as the Qs, but it comes in at 87.7. Just to give you an idea, if I'm looking to go long some kind of index or even a stock, I'll want to bring up a chart like this, and I won't even consider it unless it's in the high 80s to even into the 90s. The better looking the score, the better I like it. Now, some of you may not agree with that, but that's the approach that I use. Then coming in third place is the Dow. It did tick up just a little bit where it's showing some improvement. It gave a score of 71.6. The mid caps, also a little bit of an improvement lately, but they're under 50 and coming in at 46.6. And then in last place, even though they ticked up slightly, are the small caps. And they've been under a lot of pressure lately. And they've been really underperforming, and they come in at 35.2. Now we look at some short-term charts. This is the Stochk RSI, and this is pretty touchy. If we have a couple of up days, this becomes extreme positive. If we have a couple of down days, it becomes extreme negative. But it can tell us two things: when we're going too far, too fast in one direction or the other. But then if we get up into one of these higher areas or lower areas and then camp in that area, that's really suggesting strong either upward or downward momentum. Right now, after getting extreme positive, we're falling back. This is still positive because we're above the midpoint, but at the same time, it is declining. Then we look at the Williams percent R, another pretty touchy indicator. You can see lately it's really been pegged down near the bottom. So that's more negative than positive, but we just keep an eye on these. And then we have the CCI 14, which is a little shorter term. It's still above the midpoint. And then we look a little further out to the CCI 20. It's also just barely above the midpoint. Then I have a thing called the boom indicator, and I created this indicator a long time ago, and there's some logic behind it. I only came up with the name a few years back, where we look at a 20 period, 50 period, and 200 period moving average. And then we compare where is price to the moving averages. When we get really far away from any moving average, price has a tendency to come back to that moving average. Up on the top, it is the 20 period moving average, and we would hit that first. And we use this like an oscillator. It can be either extreme positive or negative. Right now, we're just in about the middle. Then we also look at the 50 period moving average, and we're just about at the midpoint there. And we're doing okay when we look at the 200-day moving average. When the market is really moving in one direction or the other is when this indicator becomes more useful. Then we have what I call a short-term rainbow, and it's kind of cool looking with all the different colors and everything. We go with 10 periods all the way up to 50 periods, and we're still kind of inside the rainbow. We were trying to break out of this, but if we fall down below the rainbow and see all of the colors roll over, that would turn more negative. If we can get up out of the rainbow and see the colors turn back up, that would be more positive. Then we have some moving average studies. We look at a 20, 50, and 200-day moving average based on the exponential way of measuring moving averages. We're pretty much sideways with the 20, declining a little bit with the 50, and down to sideways with the 200. Then we're looking at the 100 period moving average. A lot of times when we get into sideways markets for extended periods of time, that's when the 100-day moving average may become more useful. Typically, we'll use the 20 for the short term, 50 for intermediate term, and then we'll jump all the way out to 200 for the longer term. Well, as we were having trouble in August, we didn't quite get down to the 100-day moving averages, either a simple or exponential version of this chart. And so right now, it looks like this support level is holding. We keep an eye on the fundamentals. We're on the top. We have the price chart of the S&P. Then we have the earnings, which are flattening out now. Even though we've been dealing with earnings season, they haven't really flowed through to update this chart yet. And then we look at the PE ratio. The more we go up, the higher the PE ratio gets. And sometimes that turns the market into being expensive. And then an inverse of that is looking at the yield or the dividends that you would get by owning the S&P 500. And when it goes up, that means that the S&P is typically going down. We look at some intermediate term charts. We have a Connors RSI. This could almost be a short-term chart. We use this like a regular RSI where we look for extreme positive and negative readings. When we're above or below the midpoint, can suggest what bias we have, either positive or negative. But this really moves quickly, but we don't get an awful lot of extreme readings using this chart. The CMB composite, we did get an extreme positive reading, and now we're dropping back down. This is designed to be a standalone trading system, but I don't use it like that. I put the black lines on the top and on the bottom, where I use this more like an oscillator. And then we have the 100-day moving average again, in case you didn't see it the first time. Then we look at the vortex, and when the green line is going up, that's positive, especially when the red line's going down, and then just the inverse of that is also true. Even though we've been seeing a little bit of trouble lately, the green line continues to advance. So this is still suggesting that things are positive. It's interesting. Now I have two of these charts as well. Okay, then the Chaikin oscillator works like any other oscillator. When we're below zero, that means negative. Above zero, that means we're positive. We look for extreme positive or negative readings. We're showing some improvement here, but we're still below zero. The money flow, also another oscillator, but this one's more positive. We're above 50 and advancing. The ultimate oscillator, this is negative. We're below 50 and declining. On balance volume, where we're below the moving average, that's negative, even though we ticked up a little bit in Friday's session. Then we look at a different study. We have the 200-day moving average study on the top, and that's been declining, so that's more negative. And then we have a 50-period moving average study based on the S&P on the bottom. And that tends to move a lot quicker because these are shorter moving averages. We look at a point and figure chart where nothing new was drawn. When we're going up, those are X's that are added to the chart. When we're going down, those are O's or zeros. And then what this software will do is automatically generate some kind of a signal. We don't have a signal that we're working off of right now. The blue lines down here just suggest that the overall trend continues to be up since the lines are underneath an advancing chart. Then we look at the Bollinger Bands on the top. And I did show this in the video because we're just about at the midpoint now between the Bollinger Bands. But then we have another thing called the percent B indicator. When we really move up or down, we will get an extreme positive or negative reading on this chart. We're a little bit more positive now because we're above the midpoint and ticking up. But usually how we use this is to get extreme positive or negative readings. Then we have an intermediate term rainbow going from 50 periods up to 100. And because these are a little bit slower, even though we've been seeing some weakness in August and then a little bit more in September, we're still dealing with the upper end of these moving averages. I have to clear my throat. Sorry about that. These are all take one videos that I do here. Then we look at standard deviation. How far are we deviating or getting away from the standard or average price over the last 10 periods? We're just a little bit below the moving average now. I don't use this indicator all that much. There's other ways that I implement the use of standard deviation that is different than this. Then we have the Special K daily chart. And I talk about this in every video that I do each day because it is still positive. We're above the red line. But since we haven't changed, you can see we might get one or two signals every year to year and a half with this chart. Well, we crossed over positive back in June. We're still positive, even though we were showing some weakness. But because we don't get very many signals, I just mention it without necessarily showing the chart. Then we have the Pring bottom fisher, which it might be starting to generate a signal, but sometimes this can give us false signals. This is pretty good at picking up when the market's really been going down strong and we're about ready to hit a bottom. And then it can cross over positive, meaning it goes above the red line. But when we really get good signals from this is when we get a good deep reading to the downside. That will usually be more positive. And then we have the Sean trend meter, and we're neutral right now. When we get up into these green areas, that's more positive. When we get down into this pink area, that's negative. Then we have an anchored moving average going back to the all-time high for the S&P. And even though we've been having some trouble lately, we're still well above this moving average. Then we like to keep an eye on how far are we above or below the 200-day moving average. Well, we continue to be above it. And then we compare the S&P 100 with the S&P 500. And the big mega cap stocks have been outperforming, but we saw more of a real divergence last spring when the S&P 100 was really going up while the S&P 500 was going sideways. And they're moving more with each other now, but because the bigger stocks are doing better, the S&P 100 has been performing better. Some long-term charts. We have a 50 period up to 250 period moving average in this rainbow, where we're just coming into the top part and we're not really seeing these longer term moving averages rolling over yet. So far, our longer term trend is still hanging in there. Then we have a moving average study where the 50 period, that's really just for reference on top. We look at a 150 and a 200 period moving average study, and we're still above this blue line, both with the 150 and 200. So even though we're seeing some weakness, we're still maintaining a positive stance in the background longer term. Then we look at a weekly chart of the S&P and a weekly chart of the German DAX, which is their main index. Sometimes there's a strong correlation between the two. Well, this is really dropping off now, so the correlation is just not happening right now. Then we look at the 10-year yield and we subtract the German 10-year yield. That gives us the result that we can plot up here on this top chart. And then down in the middle, we have the US dollar index. And sometimes there's a pretty strong correlation between the top chart and the middle chart. Right now, even though it's improving, we're not really seeing a strong correlation, but this could always change. Looking at some support and resistance, I refer to this in every daily video, but I only show this chart in this video because we're far away from this red line. How this chart was created was we drew a line from the low that we hit in June 2022 and also October 2022. That's the blue line on the bottom. And then I went to the all-time high and drew a parallel line to this lower trend line. And as we were going up last spring, we had some trouble getting through this point right here. And it looked like this could really provide some overhead resistance. And we bumped into it a number of times. But we were finally able to break through this and then really keep on moving. So this indicator hasn't been all that relevant lately. Now, if we really start to fall, we'll be seeing if we come back down to this red line, but we're just not seeing that yet. Then we take a measurement from the COVID low to the all-time high, and we just break it up into what are called quadrants. Each one of these is 25%. Earlier in 2023, this was providing some pretty significant overhead resistance, but we were finally able to break above that, and we're still above that, and we're kind of in no man's land on this chart right now. If we really start to fall, we'll be keeping an eye on this other, what had been resistance. If we fall, then it would be hopefully become support. Then we have a short-term fib chart, and we're well above the 100% retracement. As long as we're above this level, I haven't been showing this chart. Longer term, also, we're above this 61.8% retracement level. And unless we really start to fall, I haven't been showing this. Now, back in August, when we were coming down, we almost made it down to this point, and I was showing this chart a lot. But now that we have a little bit of breathing room here, I haven't been showing it. Then we take a longer term fib study where, if you'll see the different colors here, these are actually different Fibonacci levels that are on top of each other. So yeah, you can make some mathematical sense out of what's happening in the market. But when we look at where price is compared to these lines, we're back in no man's land now. So this really isn't helping us. If we start to fall, we'll be watching some of these other levels to see if they provide support. If we really get going to the upside, we might be able to break above this and set a new all-time high. Looking at the broad market, we use the Vixen, where the VIX measures the S&P. The Vixen looks at the NASDAQ 100. I mainly pay attention to the line chart on the bottom, where we've been showing that there's been an overall decrease in fear. Then we look at a different study. There's discretionary versus staples. But then there's some ETFs out there that are equal weight, where it's treating everything the same. So we have the equal weight ETF on top, and then the staples on the bottom. And then we take a ratio between the two. When this is going up, that means that discretionary is outperforming staples. Even though we've seen some recent weakness, this is still showing that discretionary is outperforming staples. Then we have a weekly chart of the QQQs, and then another anchored moving average going back to the all-time high, and we're still well above that level. Then we look at the NASDAQ 100. We're also still above this 61.8% retracement level. Now, when we were coming down, I was using this chart quite a bit, but we didn't quite get down to this level. And now that we've been going back up, I haven't been showing this chart. Look, keep an eye on the banks. We have the bank ETF, where we had come back up to the 200-day moving average, and then we started to see some weakness. We came down to the 50-period moving average, and now we're continuing to drop below. When the blue line is below the red line, that means we're in a downtrend. Then we look at the financial sector, and believe it or not, it generated a recent golden cross, but it's just been getting hammered lately. But moving averages move slower, so sometimes we can get some whipsaws from that. Then we look at the financial sector and compare it to the S&P, where it is continuing to underperform. And then we look at the regional banking ETF, which has been getting hit pretty hard, and compared to the financial sector, both of these have been weak, but the regional banking ETF has been even weaker and is underperforming. Then we're keeping an eye on the financial sector. We set a high back in 2007, right before the great financial crisis. And it took us a long time to get back up to this point. And we hit this previous high just about the time we saw the COVID plunge. Isn't that interesting? And we have other charts that were topping out just at about that point. Well, after all this money came into the market and added all this liquidity, we were able to break through this. Once we break through a resistance level, if we're coming down, that now becomes support. And we've come down here a few times and tested this, even fell below it for a while. But right now, we're still holding out above this support level. Then we look at a ratio between the Qs, which is the NASDAQ 100, and the diamonds, which is the Dow. And then we have a chart of the S&P on top showing at the bottom here that the correlation between this ratio is pretty strong. We want to keep an eye on the Dow and the transports. The Dow is the black line. The transports is the red line. The transports had been doing quite well, and we're actually starting to outperform the Dow, but now we're just seeing the reverse of that, where the Dow is outperforming the transports. In a more solid environment, we want to see the transports doing really well. Then we look at the S&P, which is a weighted index, and compare it with an equal weight index of the S&P 500. When this ratio is really going up, that means that the mega cap stocks are really outperforming, and you probably have been hearing about that, so it's no surprise that this has been going up. Then we look at the cumulative new highs and new lows for the NASDAQ. And for quite a while now, actually a few years, this has really been showing some continued weakness. We also have a raw score down below. When we're below zero, when we just measure the new highs minus the new lows, that's negative. When we get a positive answer, or positive answer, that's looking more positive. And then this just measures what is the cumulative effect over a period of time. And that hasn't given us a lot of confidence in the NASDAQ, even though it has been performing well in 2023. Some rate of change charts just to show you. I have a lot of rate of change charts from 1 day all the way up to 250 days. This just compares the price right now with 250 periods ago. When it's going up, that means we're positive. When it's going down, that's more negative. We can also look at a longer term version of this chart going all the way back to 1980. It's interesting to look at, but I kind of use the rate of change charts on different time frames. I'll only bring them up when something is actually happening with the charts. Keeping an eye on bonds, where we have the S&P on top in red, and we have the TLT, which is the long-term bond ETF. That's in blue. And then this shows the relationship between the two based on 50 periods. This is their longer-term relationship, and it's starting to get a little bit stronger. Bonds have been going down as the S&P has been going down. Then we look on a shorter time frame. We go back 10 periods to see what is their short-term relationship like. And when it goes up, that means their relationship is pretty strong. It's not really showing anything all that important right now. And then I have a couple different versions of the spread. Here's the S&P to the TLT on top. Here's the TLT to the S&P on the bottom. And the spread continues to be quite wide. We keep an eye on all the different yield curves. The ones that the market follows the most are the 10 to the 2-year, and that's still inverted. And then the 10 to the 3-month, which is also inverted. We have the 30 to the 5, the 10 to the 5. I don't really use this bottom one now because one of the parts of this chart doesn't exist anymore. But this just shows us that our yield curves remain inverted. Then we look at how are bonds performing in relation to stocks. Well, bonds are underperforming even though they've been bouncing up a little bit. Stocks and bonds have run into some headwinds as we're going through August and now into September. But stocks still continue to outperform if you look at an inverse of this same chart. Then we look at the value to growth ratio. Now, most of the time we study the value to growth, the growth to value ratio. This looks at the value to growth ratio. And then we also plot in red here the 10-year yield. They're pretty much neutral right now. Sometimes they have a tendency to go in the same direction, sometimes in the opposite direction. Right now, this isn't telling us very much. Then we look at the QQQs, which is the NASDAQ 100, and compare it to the TLT, which is the long-term bond. They're having more or less a tendency to go in the same direction. Well, stocks have been having problems and bond prices have been having problems. That's why we're seeing this correlation get stronger. Then we look at the equal weight S&P 500 ETF, and then we take the MOVE index, which measures the volatility of bonds, and then we invert it to see if we can get any insight from this. And no, right now we're neutral. Then we look at the 3-month yield. Back in 2007, we topped out and then started to come down. And this was signaling that there's a real problem in the market as we went into the great financial crisis. Well, right now, in fact, earlier in 2023, we broke out above that 2007 level. And we're waiting to see, are we going to roll over and start to come back down? Sometimes it looks like it's getting ready to do that, but for right now, it's just not happening. Then I have a number of things that are called possible positive scenarios. And these were really useful in 2022 when we were chopping all over the place. We'd go down and then up, and then we go up and then down. Well, these are designed to try to pick out when are we at some kind of a bottom in the market. We can also use them in a more negative way to see when maybe we're hitting a top. The first thing that we look at is a ratio between the Qs and the S&P. When this is going up, that means that growth is outperforming value. Discretionary, another form of growth. When this is going up, that means that the discretionary sector is outperforming the S&P. And then we look at large cap growth and compare it to large cap value. When that's going up, that's more positive for the market. Then we look at different growth to value ratios. Again, here's the large caps, mid caps, and small caps. We really haven't seen a lot of changes in this, so I haven't been showing these charts. Then we look at a 10-day average of the S&P 500 highs minus the lows. We use this like an oscillator. When we get extreme positive or extreme negative, we can also get a bias from this. When we're below 50, that's negative, and that's where we're at right now. To turn this back more positive, well, I guess not. That's where the red arrow is. But right now, we were able to cross back above 50, and we're getting a reading of 52, actually 62. And then we look at a broad range of the Amex, NASDAQ, and NYSE. We take a 5-period moving average of their highs minus the lows. When it's above 0, that's positive. Below 0, that's negative, and we continue to be below 0. Then we look at the percent of stocks in the S&P 500 that are above their 200-day simple moving average. We're just barely above 50 now. There are times when we really get moving where we can use this like an oscillator to get an extreme positive or negative reading. Then we take a 50-period exponential moving average of the new highs minus the new lows. When we're in this blue area here and above the 0 line, that's positive. And we were looking a lot better until August rolled around this year, and now we've been declining. We're still positive, but we're showing a decline in this overall indicator. We get the indicator from this next chart. That's the black line. And then on top of that, we have a moving average. That's the red line, and that's what's plotted on the previous chart. When we're above 0, that's more positive. Below 0, that's negative. But right now, this has been declining, even though it's still above 0. Then we look at the 19-day exponential moving average of the advanced decline ratio. We can look at it based on price and volume, and we're just about at the midpoint now with a slight negative bias since we're below 0. Then we look at the S&P and the stocks above their 50-day moving average. Again, we're a little bit above 50. We can often use this for extreme positive or negative readings. We also look for that on the mid caps. They're actually a little bit more negative and not giving us any kind of an extreme reading, and the small caps are even showing more weakness now. Then we look at the 2-year yield and we compare it with what is the S&P 500 doing. Sometimes when the 2-year yield tops out and starts to come down, that may give short to intermediate term support to the S&P. Well, for a large part of 2023, the S&P and the 2-year yield have been going in the same direction. They're going in the opposite direction now, but stocks have been more under pressure as interest rates have been going back up. So we're not seeing this overall 2-year yield starting to come down, at least yet. So thank you. I hope you found this helpful. Please feel free to check out the other videos that I post. I hope you have a really great weekend, and I will talk to you in the next video.